Welcome to the TrustBridge Capital Market Observations Call for the week of December the 12th, 2022. I'm your host, Eric Jefferson, and before we get started here, have a few quick words from our legal team. With that, we'll go ahead, dive right in, start by recapping last week, which saw the S&P trade lower 3.5%, has now been down in 6 of the last 7 sessions. The headline there was slightly better than expected economic data. The classic case of good news is bad news, good economic data, bad news for markets, based on the expectation that we would then get a more hawkish Federal Reserve, or one that will continue to push interest rates higher and higher in order to combat what is obviously historic levels of inflation. That is a topic where there's a lot of anxiety in the markets today, specifically around how high will rates go and how long will they stay there. Currently, markets are pricing in a terminal rate, or the level at which interest rates cease to increase, pricing in a terminal rate of 5%, and then with the expectation that that will begin to be cut in the early second half of next year. To give some historical context, on average, interest rates, once they reach that terminal level, will stay there for 11 months. That is obviously a huge disconnect if we assume that rates will continue to rise in the first few months of next year. The other question that nobody has the answer to, including Fed Chairman Jerome Powell himself, is what level of falling inflation is acceptable or is needed to prevent additional rate hikes. Granted, may get some clarification on that topic later this week. On Wednesday, the Fed will have a big announcement, widely expected to raise interest rates by 50 basis points. Believe it or not, that is actually a reprieve from the 75 we've experienced as of late. And interestingly enough, from a timing perspective, that announcement will come following Tuesday's inflation report. We get CPI, which is expected to be a 7.3% increase year over year, 6.1% if you strip out the more volatile food and energy. Again, that may sound like a historic figure, which it is, over 3.5 times the long-term average of 2%. However, 7.3 actually represents some meaningful progress down from the 8% levels we saw earlier in this year. One other piece we'll be watching very closely in the Fed commentary afterwards is whether or not they acknowledge how resilient the economy has been despite the historic rise in interest rates that we've already experienced. On the surface, there are still a lot of positives. In the face of higher prices, consumers are still going out, are spending, are living their lives, and the labor market remains very, very strong. However, as we start to peel back some of the different layers in the data, the stronger points tend to be more the lagging indicators, or the story of what's happened in the rear view as opposed to what is happening or what may continue in the path ahead. Some of the leading indicators, things like initial jobless claims or the use of credit in order to fund lifestyles in the face of higher prices, have started to soften. Again, going to be very interesting to see what data points they emphasize. Historically, the biggest critique of the Federal Reserve is that they make decisions based on stale data, make decisions based on looking in the rearview mirror, as opposed to what's on the windshield ahead. Obviously, we'll keep a very close eye on that and report back accordingly. The end of the day, though, story of all this, or point of all this, there's a lot of mixed messaging out there. If you look at the bond market, for example, historically speaking, there are two very good recession indicators. The first, a inverted yield curve today, arguably the most negative it's been in quite a while. That is a strong recessionary indicator. However, credit spreads have barely widened, suggesting there's nothing to worry about on the horizon. Mixed messages within that asset class. Same thing within equity markets. Currently, markets pricing in a 5% earnings growth for next year, where typically in a recession year, if it occurs, earnings will fall by 20 to 25 times. So again, we think about what the market is telling us today, very, very mixed messages of recessions coming or it's not. The last piece, if we even just look at the different underlying stories. China reopening, one of the things that we talked about, certainly a catalyst for the market. We've seen a rally over the last month or so resulting from that reopening theme. Obviously, a benefit if the second largest global economy comes back online. However, as we start to peel back some of those layers, where China is the largest consumer of commodities, see energy, for them to come back online means they need to consume more energy. It means they need to buy more energy, which ultimately means the price of energy likely set to increase. That would do very little, in fact, do the opposite of Powell's intended goal to bring inflation down. End of the day, share all of this to suggest a lot of mixed messages out there. There's a saying, if you don't have an opinion, don't have a position. And as a result, we've maintained a fairly conservative allocation on both the equity and the bond side. With respect to bond or fixed income positioning, remain underweight duration. That refers to the more rate sensitive segments of the market based on our expectation that interest rates may even tick higher based on where they are expected to today. And then flipping to the equity side, our thought process there, market's currently trading near the upper range of our forecasts. And so if your expectations are for a flat or potentially negative market environment ahead, being a little more defensive will only work in your favor. Lastly, from an implementation standpoint, so we think about what are the underlying companies, industries, segments that we're invested in. At the end of the day, our highest preference as for those companies that generate enough cash flow to fund their own operations and even any expansions. The thought process being the end of free money is over. When interest rates are at zero, very easy for a company to borrow money and expand their operations. However, interest rates go higher, companies now have a much larger interest expense. So a much bigger chunk out of their revenue is allocated to paying for that capital. That obviously puts downward pressure on a company's profitability. And therefore, we believe it's those companies that have the ability to fund themselves based on their cash flow, therefore don't have to borrow and pay that penalty of higher interest rates, are typically the ones that are going to get rewarded in this choppier, more uncertain environment ahead. That's all for this week. As always, happy to discuss anything we spoke of in more detail. If you don't connect, have a great rest of the week. Take care.